We're live. All right. Good to see you. Thank you for joining me. I'm Mitch Goldberg. You're watching my live stream, Be the Boss of Your Money. I have to make this a quick show. I've got to be somewhere in a little while. The 50 most powerful and influential women in business on Long Island. A dear friend of mine is one of the recipients of this reward. So I'm going to be at the Crest Hollow Country Club, which is a massive facility to hold lots and lots of people. So I'm going to run home and put on a suit before I go. Yeah, so we'll make this a quick show. You know why it's also a quick show? There's not much to talk about because everything right now just became about Amazon and Apple. All day long today it was about Facebook, which dropped about 22, 23% on the day. There's a few important things we need to learn here. Teachable moment from the absolute effing freaking mauling in large cap tech stocks, which we've seen before, by the way. This is not the first time we've seen wealth destruction like this, which is, by the way, why we don't overindulge in techs, which is why I've been saying a bunch of things. It's not why I said this, I said that. It's let's what are we going to learn from it? Anyway, I'm Mitch Goldberg. You're watching Be the Boss of Your Money. We're going to talk a couple of lessons here from this tech wreck, and this is an absolute mauling. If you didn't think we had a tech wreck already, which we did, we are having it now, and we are up to our eyeballs in it. So let's roll the introduction, and we'll go over a couple quick things, and I'm going to let you go. If you have any questions, please hit me up in the comments. I love hearing from you. It's the best part about doing this is when I hear from you. And if you don't mind, give me a thumbs up or a heart or a wow or an applause, some reaction, whatever, depending on which social media platform you're watching on. It helps the show grow. It helps get me in front of more people. It helps spread the good word to your contacts of the good work we're doing. I produce all this myself, from the equipment to the content to the broadcasting, everything. So I'd really appreciate the help there, the assist. So we're going to roll the intro, and then we're going to have a good, quick show, but it's going to be really interesting. Here we go. All right. If I look like I was just staring at the screen for a second, it's because when I play the intro, sometimes it gets a little glitchy and it stops. It happens maybe once or twice a quarter. It's not something that happens a lot, but it's something that once in a while happens. So I just kind of know how long it's supposed to last in my head. So let's just take a quick look first at the really the big story of the day. It's not Facebook. I can tell you that has already come and gone. So let's do a quick share. Put you on the other screen, okay? I'll get rid of the social media stuff there. Okay, so Apple is down a measly 1.25% aftermarket trading. It was down about, I would say, 2.5% a little while ago, 3%. But cooler heads look like they are prevailing. We'll see how it goes for the rest of the night and tomorrow. This is all aftermarket trading, but Apple just came out with the earnings. The earnings revenues were good, but they were light on iPhones and they were light on services. And Apple has been all about moving to services. And of course, their Apple is their mainstay, their cash cow, their everything. And people wanted to know how they did with iPhones. But, I think the forgiveness for them in being light on iPhones is that iPhone 14 was only out for like the last 8 days of the quarter of the last quarter. And a lot of people, when they are about to buy a new iPhone and they know the new model's coming out in like a few weeks, they stop buying. They slow down their buying because they know that the phone they're about to buy is going to be marked down $100, maybe more, or they might just want to wait for the same price and get the newer phone. So that's part of it. I think analysts thought though that maybe iPhone 13 would hold up a little bit better, but nonetheless, there was a lot of weight put on the 14 and the 14 Pros, especially for the cameras. So nothing major. It looks like I think Apple's numbers are being taken in stride. the thing is, Apple is the biggest company in the world. It's the biggest component in the S&P 500, in the Nasdaq 100. It's a nice sized component, not the biggest, but a component nonetheless in the Dow Jones Industrial Average. So it does have a certain gravitational pull. And then Amazon down almost 17%. It was down more, by the way. It was down about 20%. So at least at the second that we're broadcasting, Amazon is bouncing off a bit off its bottom, but still, I mean, down $18 and change per share is a huge drop for Amazon. Facebook dropped out of the 20 top biggest companies in the S&P 500. I don't think Amazon has gone down enough to do that, but we'll find out. We'll find out tomorrow. Okay, it's not really important right now. What's important now is that Amazon is absolutely getting crushed. It's now. So there's a couple of things I want to unwrap here. Okay. First of all, this is always the peril of tech stocks. When tech stocks cool off, they go ice cold. I mean, they just roll over and they just crawl into a hole, and that's the end of it. So it's this has happened before, and this is why people like me are always weary of too much tech, no matter how good it is. Plus, when you have tech about 35% of the S&P 500, you know that investors are putting a lot of stock, no pun intended, into technology. And I've seen this before, the 2000 tech wreck. And I know, it's a long time ago, but to me, it doesn't feel like it was that long ago. Even though it was year 2000, it was a pretty miserable time. So, I still remember it very clearly because, there's an old expression: lessons learned hardest are lessons learned best. So we've seen tech stocks get mauled before. I remember when Lucent was $100 a share, and it went down to $1, and it has never even come close to recovering. My friend Jay is out there, unfortunately, tech or direct right now, watching for buying opportunity. And okay, so Jay's watching, for a buying opportunity, and I don't blame you. I mean, I am too. But the thing with tech is when they start doing this, it's endless how much they could go down. I mean, what if I told you that Facebook could go down to like $30 a share, or Amazon could go down to, $40 a share from here? What if I told you Apple could get cut in half? Because these things happen, and that's the thing. It's like they never stop going down. Is the worst bear case scenario. That was the year 2000. And people have been buying these big tech stocks on the way down this whole year, thinking that they've got a bottom, they've got a bargain, they're going to go back up soon. Wait till the next quarter is out. Wait till the next announcement is out. Wait till the next product is out. But they keep going lower and lower and lower. And they're not lower by a little bit. We're not like talking, oh, maybe they'll go back down to their lows of, their June lows. And maybe they'll go to their August lows. No, these are just making brand new lows. Now we're talking about October lows in these stocks. Okay. So what say you, Jay? That's why I look at QQQ or XLK instead of being levered to one stock. Yeah. So Jay, you make a good point. The QQQ, that's the ticker symbol for the Nasdaq Composite, the tracking ETF, and XLK tracks the tech sector. That's the S&P Depository Tech Sector, the spiders. XLK, very popular ETF to trade the tech stock. So, individual stock risk is really glaring right now. And what I say to people who are trying to decide between individual stocks and what I say to people who are trying to decide between individual stocks and a more diversified approach, like using mutual funds or exchange traded funds, which could also be index funds, is that individual stocks don't always recover, but the averages have always recovered. But individual stocks have not always recovered. So that kind of tells you a lot about the risk of individual stocks. Now, just so you know, diversification is a strategy that we use to mitigate risk, but it doesn't necessarily prevent your portfolio from going down in a generally down market. The other thing is that you can't invest directly into an index fund, but you could invest in a security that tracks or mimics an index. So just to get those out of the way. All right. So the thing with the tech stocks is if you wanted to, if you wanted to have a good year during the pandemic and 2020 and 2021, you owned Fang M stocks. You owned Facebook, Amazon, Alphabet, Netflix. Okay, you own Apple. If I didn't say Microsoft, Nvidia, these are the stock. These are like the big six stocks that you would own. And if you own these, you were actually beating the market. And these companies had stellar, or they still have stellar reputations, great businesses, great leadership, constant growth. Everybody's using them, and the sky's the limit. Well, the sky's not the limit, but these pulled the market up. And if they went up, the market was pulled up by them because they're so big. In other words, the Standard & Poor's 500 index is a market cap weighted index. So $8 trillion company that loses $1 a share could be felt in the S&P 500 index. But a $200 billion company that loses $1 a share, it's going to barely be a blip on the S&P 500 index. Okay. I don't think you'd even notice it. So the big companies, as they come down, they pull the averages. As they've been going up, they've been pulling everybody with them. But the amazing thing is based on how the Dow Jones is doing, the Dow is up today, in spite of Facebook and other tech stocks getting cracked. Not that the Dow is near its old former high. It's just been going up a little bit, holding up better than the S&P and the Nasdaq. But it is pretty amazing that the market is finding resiliency in the face of these technology behemoths that have been getting crushed. So it goes to show you there is a plethora of stocks that are holding up and or going up. And that is a very bullish sign that there are enough stocks doing well to counter the gravitational pull of these six massive tech giants that I just told you about. Okay. We'll see how it goes tomorrow. Amazon is a big component in the S&P 500, and that stock is just absolutely getting crushed in aftermarket trading. Amazon, Facebook, these are the kinds of stocks, especially Amazon, especially Google, that a lot of investors have and they felt safe with because everybody buys from Amazon. It's all Amazon. Amazon is putting everybody else out of business in retail, and Amazon has the cloud business. Okay. These companies hit the law of large numbers. Facebook finally is no longer just a secular growth story. Now it's cyclical. So as the economy weakens and advertising spending goes down, that hurt Facebook. Facebook is at the end of the day is an advertising company. So advertising is going down because the economy is a little bit weaker. It used to be that no matter what, Facebook was going to grow because so much money was moving from traditional advertising, print, broadcast, radio, going on to Facebook. But now Facebook is being challenged by the law of large numbers, and so is everybody else. This is why Netflix plunged recently. That was the first one to go with all these big tech stocks that we're talking about. So the market has been pretty darn resilient in the face of these stocks plunging, with the exception of the Nasdaq, but that's understandable because the Nasdaq is a tech-heavy index. Apple is in the Dow Jones, not Amazon. So we'll see how Apple can hold up by tomorrow morning. But right now it's down at $1.71. I don't think it's going to be that big of a deal. And the Dow could continue to keep moving up. Look, I'm not in the business of calling the day-to-day gyrations of the market. I'm looking at longer-term trends. But just to see these stocks, how they act. Like we talked about this on Tuesday night when Facebook and Alphabet came out with earnings and such bad numbers and the stocks got crushed. I said to you, the Nasdaq's going to get crushed the next couple of days. And that's exactly what's been happening. I don't see why that would stop happening. Amazon is basically, cloud is, it's good, not as good as it was. People are buying shit on Amazon. Yes, people are spending money on it. But the amount of business that Amazon's been taking away from traditional retail looks like it's slowed. It's not really, even if the economy went into a recession, Apple is going to keep growing because it's taking more and more market share from the rest of the retail industry. But there's really not much more market share for them to take. They've hit about the level of market share that they're going to get. So now these companies, these top tech companies, they actually have to show real numbers. They actually have to demonstrate how they're going to grow. And if they're only growing like, 8 or 9%, that sounds great if you're Walmart or Target. But for these big tech stocks, 8% is like such a disappointment. And when these companies are priced for that kind of high growth, it is a disappointment. And the stocks have to be marked down to what a regular retailer or computer company would be worth. So that's what's happening with these. It's a really it's a deep thing. The Nasdaq, the market has changed. The stock market is no longer what it was. The golden era of Amazon and of social media and of search is over. It's over, and that is a huge shift in sentiment. And investors are going to have to get used to that. And a lot of investors are just going to hang on to these stocks and ride them lower because they only think in terms of they're going to come back, they're going to get back to those big numbers, they're going to get back to crushing it in all these different areas of social media. No, I don't think they do. I really don't. I mean, there are things that can be done. These companies could cut costs. They could, Facebook or Metaverse could stop investing in the Metaverse, and they could do things to make the stocks go up. But to get these stocks back up to their former glorious highs of early this year, I don't see what gets them to that. And now that the pandemic is over and people are not on their screens as much, the comparisons are very tough. I don't see how these companies get back to where they were. So that's kind of a negative. It's a negative viewpoint. But this is why I'm grateful that I did not overload and overindulge on tech stocks, because these things, when tech goes cold, it's awful. And I think a lot of these tech stocks, and including these top six, are not going to make it back up to the year highs anytime soon. They might do it in a couple of years, maybe. Remember, the Nasdaq went down in the year 2000. It took till 2015 for it to regain that high. It took 15 years just to get back to even. And I know most of you are not going to hold on to a stock while it's down for 15 years just to wait for it to get back to even. Most of you will be long gone before that stock goes up. And the longer these stocks stay down, the more people are selling, and the more people are just holding on for whatever reason, because one day they hope glory days for these companies to come back. And the glory days don't come back. There's only one company in history that I could think of who truly has regained glory days and exceeded its glory days. The only one. It's a company that went out of business almost twice. I mean, it's a company that almost went out of business twice. That's Apple. Outside of Apple, I haven't seen anyone else do it. The odds are so incredibly low, I don't think it's even worth betting on. So it's a really difficult time for investors. Right now, Amazon is down 15%. It was down like 16% a little while ago. And about 18% before I even clicked to go live here. So that's what's going on. Tomorrow's all about Apple and Amazon, and we'll see how the rest of the earnings season goes. But it's pretty brutal out there. So hang in there. If you have any questions, let me know. I'm pretty cool about it. I'm not really fazed by it because my clients and I were diversified. Cash has been set aside for our needs, and we're doing it right. And if you are worried about this stuff and you don't think you're doing it right with your investments in alignment with your goals, that is a very good reason for you to pick up the phone, hit me with a DM, email me, whatever, reach out to me, and we'll talk about this. We'll see if we can get you into better shape going forward. All right. Thanks so much. I may do a live stream tomorrow, depending on how the market goes tomorrow. If not, then I'll be back Monday. Have a great day and have a great weekend. Bye.